Welcome back to the Deep Dive. It is February 15th, 2026. And if you're anything like me, you are looking at the calendar and getting that familiar low-grade anxiety in the pit of your stomach.
Oh, yeah.
Tax season isn't just approaching. It is, for all intents and purposes here. But we aren't just talking about the drudgery of filing today, are we?
No, definitely not. We're looking at what happens after you file. Or, maybe more accurately, what happens if the computer decides it doesn't like what you filed. We are talking about the modern audit.
Right. And honestly, reading through this stack of sources, we've got legal bulletins from late 2025, some really urgent warnings from accounting firms like BBA Tax and Segal GCSE, these new CRA guidelines. It just feels like the game has changed completely.
It really has.
Remember when an audit meant a guy in a suit looking at receipts in a shoebox? This sounds more like a sci-fi dystopia.
The shoebox era is dead completely. We're seeing terms in these documents like algorithmic enforcement and predictive personalization. The days of an auditor just randomly pulling a file off a shelf because it looked dusty, those are long, long gone.
So that's the big headline here, the death of randomness. But I have to ask, is that actually true? I mean, if I'm a regular person or maybe a freelancer and I get that dreaded brown envelope of the mail this year, are you saying it wasn't just bad luck?
It is highly, highly unlikely to be bad luck. Now, to be fair, the CRA does maintain a tiny, tiny percentage of random selection, just to test the system's baseline fairness. But the vast majority of audits in 2026 are triggered by data, specific, targeted data. The sources describe a data ecosystem that the CRA has built that is, frankly, staggering.
Okay, data ecosystem sounds like a buzzword. What does that actually mean for the listener? They aren't just looking at my T4 slip anymore.
Oh, far from it. They're cross-referencing digital platform data. We're talking about income from Uber, Shopify, Etsy, Airbnb, all of it. They're pulling from real estate registries to track property flips. They're receiving something called Common Reporting Standard data from over 100 countries to see your international banking.
Wait, so if I have a bank account in France or some crypto in a foreign exchange, they know?
They likely know. It's like the tax man has an all-seeing eye now. But the most interesting part, and the part that trips people up, is the benchmarking. The algorithm compares you to your peers.
This is the predictive personalization they mentioned in the legal briefs. I need you to explain this because it sounds like Minority Report. How does a computer know if I'm cheating before a human even looks at it?
It's all about deviations from the norm. Let's use a concrete example. Imagine a plumber. Let's call him Dave. Dave operates in a specific postal code in suburban Toronto.
Okay, Dave the plumber. Got it.
The CRA's database has thousands, maybe tens of thousands of tax returns from other plumbers in that exact same area. They know statistically that the average fuel expense for a plumber with Dave's revenue is, say, 10% of his income.
So they have a baseline.
Exactly, a statistical baseline. Now, Dave files his return and claims his fuel expenses are 30% of his income.
Maybe Dave just has a really inefficient truck.
Maybe. Or maybe Dave is claiming his personal road trips as business expenses. The point is, no human needs to look at that initially. The system automatically flags Dave as a statistical anomaly. He is an outlier. And in 2026, outliers get audited.
That is creepy. But I guess it makes sense from an efficiency standpoint. It's basically statistical inevitability.
Right.
If you deviate from the herd, a machine lights up.
Precisely. And that brings us to the specific triggers for this year. We have a list of red flags for the 2026 filing season that came up again and again in the accounting firm newsletters. These are the things that make the algorithm light up.
Let's get into those. What's the number one thing setting off the alarms right now?
Income mismatches. It sounds so simple, but it is the easiest thing for the system to catch. If your reported income doesn't match the third-party slips, T4s, T5s for interest, T3s from trusts, it's an automatic flag. But the real trap people fall into now is with the gig economy platforms.
Oh, I saw a specific warning about this. It's the difference between gross and net. Right?
Yes, exactly. Let's say you drive for Uber or you sell on Amazon. Those platforms report your gross earnings to the CRA. That is the total amount the customer paid.
But I don't get that amount. I get the amount after Uber takes their cut and after the fees. I only see the net deposit in my bank account.
Correct. And here is where the problem starts. If you look at your bank statements and report that net amount as your income, the CRA's computer just screams, discrepancy, because Amazon told them you made more.
So even though I never touched that money, the computer thinks I'm underreporting.
That's it. You have to report the gross amount as income and then deduct the fees as an expense. If you just report the net, you're basically flagging yourself for an audit.
That feels like a trap designed for people who don't have accountants.
Yeah.
Okay, what about expenses? I feel like home offices have been a battleground ever since remote work took over. Are they still looking at that?
Oh, more than ever. The scrutiny has intensified because the sort of pandemic-era leniency is officially over. The red flag here is claiming a mixed-use space as if it's a dedicated workspace.
Like working from the dining room table? I mean, a lot of people do that.
They do, and that's fine, but you cannot claim expenses for that space as if it were a dedicated office. You can't claim 100% of the square footage of your dining room just because you work there from 9 to 5.
And what are they looking for?
The CRA is looking for claims that are, well, mathematically impossible based on floor plans.
Mathematically impossible.
If you claim your home office is 40% of your house, but you live in a standard 3-bedroom suburban home, that ratio probably just doesn't make sense. It implies you are working in the kitchen, the bathroom, and the hallway.
Right.
The algorithm knows the square footage of your property type. If the ratio is off, you get flagged.
So don't get greedy with the square footage. Got it. Now, vehicles. The car audit. This seems to be a huge focus for small business owners.
It is. The biggest red flag is claiming 100% business use for a personal vehicle. Unless you have a second car that is purely for personal use, claiming 100% is almost always viewed as a lie by an auditor.
So what's the defense there? I assume I just need to keep a log?
You need a log, but not just any log. The sources are unanimous on this. It must be a contemporaneous mileage log.
Contemporaneous just means I wrote it down when it happened, right? Not the night before the audit.
Correct. And this is where it gets tricky. Auditors are now actually trained to spot reconstructed logs.
How can they even tell?
They look for perfection. Real life is messy. You take detours, you get lost, you park further away. If you try to reconstruct your log using Google Maps 6 months later, every trip to the supplier will be exactly 14.2 kilometers.
I see.
If your log is mathematically perfect, they know it's fake. They want to see the variance. They want to see the date, the destination, the specific purpose meeting isn't enough. It has to be client meeting with John and the odometer reading. Without that, they can deny 100% of your vehicle expenses.
Okay, note to self, keep the log messy but accurate. Now, there was one section in the outline we almost skipped, but I think it's crucial because I know people who do this. Business losses.
Ah, yes.
Specifically, people who have a side hustle that never seems to make money.
The hobby versus business review. This is a major trigger in 2026.
So let's say I'm an aspiring photographer. I buy expensive cameras, I travel, I expense it all. But I only make about $500 a year selling prints.
Yeah.
Can I keep writing off those losses against my day job salary?
For a year or two, maybe. But if you report losses consistently for 3, 4, 5 years, the CRA will step in and say, this isn't a business. This is a hobby that you are subsidizing with tax refunds.
That implies there's a reasonable expectation of profit.
Exactly. If there is no realistic plan to make a profit, they will disallow the losses retroactively. You can't just expense your lifestyle and call it a startup forever.
That's a hard reality check for the fake it till you make it crowd.
Oh.
Okay, moving on to a massive topic in the sources. Real estate. There is a stat here that the CRA recovered over $240 million in BC and Ontario alone in just an 18-month window.
Real estate is the golden goose for audits right now. And for the 2026 tax season, there are 2 major traps. The first one is the flipping rule.
This is the rule about selling within a year, right?
If you sell a residential property within 365 days of purchasing it, the profits are deemed business income.
And for the listener, why does that distinction matter? I mean, money is money, isn't it?
It matters for the tax rate. Usually when you sell an investment property, it's a capital gain, and only 50% of that profit is taxable. But if it's deemed business income under the flipping rule, it is 100% taxable.
Whoa.
It effectively doubles your tax bill on that profit.
Ouch. And there are very few ways out of that, right? I can't just say the market got hot, so I sold.
Nope. Death, divorce, serious illness, safety issues. Those are the exceptions. I decided I didn't like the neighbors, or I got a good offer, won't cut it.
Now, the second real estate trap is something called bare trusts. We saw a lot of legal bulletins about reporting requirements.
Yeah.
This sounds super technical, like something for people with offshore accounts, but you're telling me this affects regular people.
It affects arguably millions of Canadians who don't even think of themselves as having a trust.
Okay, unpack this. What is a bare trust in plain English?
A bare trust is essentially when the name on the title of an asset isn't the true beneficial owner, the most common example. A parent co-signing a mortgage for their child.
Wait, I feel like half the people I know have done that. The bank requires the parents on the title to approve the loan.
Exactly. So the parent is on the title, where they don't live there, they don't pay the bills, and they don't consider it their house. In the eyes of the CRA, the parent is holding that share of the house in a bare trust for the child.
And before, you didn't really have to tell the CRA about that, right?
Generally, no. But as of the 2026 filing deadline, you must report this relationship by filing a T3 return and Schedule 15.
And if you don't, if you just assume I'm not a rich person with a trust, this doesn't apply to me.
The penalties are steep. It's $25 per day that you are late, up to $2,500. And that's per trust, per year.
So a parent trying to help their kid could get slapped with a $2,500 fine just for missing a poacher work deadline.
Yes. And if they miss it for 3 years, that's $7,500. It is a massive compliance trap.
That is nasty. And there's one more shadow inventory issue with real estate, the principal residence exemption. I think many people still believe that because the sale of their own home is tax-free, they don't need to report it.
And it's a dangerous misconception. You must report the sale on Schedule 3 of your tax return. If you don't report the sale, the statute of limitations on your entire tax return never closes.
Wait, explain that. Usually the CRA can only audit you for, what, 3 years back?
Typically 3 years from the date of your assessment, but there is a specific clause. If you fail to report a real estate sale, the clock never starts. They could come back 10 years later, audit that sale, deny the exemption because you didn't report it, and stick you with a massive bill plus interest.
That is terrifying. Just check the box and report the sale, people. But speaking of terrifying, we have to talk about the nuclear option.
The lifestyle audit.
Or the net worth assessment. This is what the CRA uses when they don't believe your books at all. They stop looking at your receipts and start looking at your life.
And this is where the math gets brutal. I want to walk through this slowly so everyone understands the gravity of it.
Okay, let's do it. I'll be the guinea pig.
Great. The CRA takes a snapshot of your net worth on January 1st and another on December 31st.
Yeah.
Let's say over the course of the year, your net worth went up by $50,000. Maybe you paid down some mortgage, put money in savings.
Okay, so I made $50,000. That seems simple.
Not so fast. That's just what you saved. Now they have to figure out what you spent. They look at your lifestyle. They see the car payments, the grocery bills, the utilities. They see you went on a trip to Disney World. They estimate that it cost you $80,000 just to exist for that year.
Okay, so I saved $50K and I spent $80K.
So doing the math, $50,000 growth plus $80,000 spending means you must have had $130,000 of money coming in.
I see where this is going. If I only reported $60,000 on my tax return.
Then there is a $70,000 gap. And the CRA assumes that $70,000 is unreported income. Maybe it's cash jobs, maybe it's illegal gambling. They don't really care. They assess tax on that $70,000.
And I have to prove them wrong.
That is the kicker. The burden of proof shifts to you. You have to prove that money came from a non-taxable source, like a gift from grandma or an inheritance. If you can't prove it, you pay tax on it, plus penalties.
What triggers this kind of audit? Is it just random?
High discrepancies. Reporting poverty line income while buying a $2 million home is the classic one. But increasingly, it's social media, the Instagram flex.
So if I'm posting photos of my new boat and my trip to the Maldives, but I reported $30,000 in income?
The algorithm matches the geolocation of your vacation posts and the estimated value of your assets against your reported income. If they don't match, you get a letter.
So privacy settings aren't just for your exes anymore. They're for the tax man, too.
Indeed. Now, we also need to touch on the legal landscape, because 2026 has brought some new powers to the CRA that didn't exist a few years ago. We need to talk about the Notice of Noncompliance.
This sounded serious in the legal bulletins. What exactly is it?
It's a tool to stop people from stalling. In the old days, taxpayers would just drag their feet, hoping the auditor would run out of time or give up. Now, if you delay or ignore a request, the CRA can issue this notice. It comes with daily penalties.
So you can't just try to run out the clock.
You literally can't because of the stop the clock rules. If you dispute a requirement or delay providing documents, the limitation period, that deadline for them to finish the audit pauses. If you stall for 6 months, their deadline extends by 6 months.
They have really closed the loopholes on avoidance, haven't they? And I read they can also compel third parties now.
Yes, under Section 231.2 of the Income Tax Act, they can force banks, business associates, even your suppliers to hand over documents.
So if I tell the CRA I didn't buy that much inventory, they can just go to my supplier and ask.
Exactly. And the supplier has to comply. You can't hide behind other people anymore.
Okay, this has been sufficiently terrifying. We have established that the machine is watching, the laws are tougher, and the penalties are higher. Let's pivot to the survival guide. The letter arrives. It's real. My heart is pounding. What do I do?
First rule, don't panic, but absolutely do not ignore it. The ostrich strategy, burying your head in the sand, is the worst possible move.
Why? What happens if I just don't open the envelope?
The audit happens anyway. They will assess you based on assumptions, usually the worst-case assumptions, and then start collection actions. They can garnish wages, freeze bank accounts. You have to engage. Those deadlines, usually 30 days to respond, are real.
Okay, so I engage. Now, there are different types of audits, right?
Most often, it's a desk audit. You get a letter asking for proof of a specific claim, like your medical expenses or that moving expense. You mail or upload the documents. If they check out, it's over. It's purely administrative.
But sometimes it is a field audit. They come to your business.
And this is where the golden rules of engagement come in. The sources were very specific on the etiquette here.
Rule number 1, professional courtesy.
Be polite, provide a quiet desk. If they are in your office, treat them like a professional guest. But, and this is crucial, do not babysit them.
Right.
And do not overshare.
This is the need-to-know basis.
Exactly. If they ask for 2024 invoices, give them 2024 invoices. Do not give them 2023 and 2025 just to be helpful. Do not offer to show them your new product line. You are just giving them more surface area to find mistakes. Answer the specific question asked, then stop talking.
And I love the tip about staff control. Discourage staff from gossiping with the auditor.
It sounds funny, but it happens all the time. An auditor is sitting in the break room having a coffee, and an employee walks in and makes a casual comment like, "Oh yeah, the boss took the company truck up to the cottage all summer. It was great."
Boom. Audit expanded. Now they're looking at vehicle benefits.
Instantly. Casual comments are dangerous. Keep the interaction professional and limited to the people who actually handle the books.
Now here's a question.
No.
What if you are listening to this right now and realizing, oh no, I messed up. Maybe you didn't report that bear trust for your mom's house, or you missed some crypto income. Can you fix it before they find you?
You can, but you have to be fast. This involves the Voluntary Disclosures Program, or VDP. It underwent significant changes effective October 1st, 2025.
What's the catch?
The catch is the distinction between prompted and unprompted.
Okay, explain the difference.
Unprompted means you come forward voluntarily to fix a mistake before the CRA has contacted you or taken any action related to you. If you do that, you can generally get 100% penalty relief and avoid prosecution.
But if they find me first?
If they send a letter, or even if they contact you about a related issue, say auditing your business partner, your disclosure becomes prompted. The relief is severely restricted. You generally won't get penalty relief, though you might avoid criminal charges.
So it's a race.
It is a race between you and the algorithm. If you know you have a skeleton in the closet, you need to open that door yourself before they knock on it. Once they knock, it's too late to say, "I was just about to tell you."
So to wrap this up, it feels like the theme of 2026 is precision.
Precision and documentation. The era of close enough is over, because the CRA's computers don't do close enough, they do exact matches.
The advice boils down to: keep contemporaneous logs that aren't too perfect. Report everything, even the tax-free stuff like your home sale. And if you get that letter, treat it like a legal proceeding, not a casual chat.
And verify your status. Check if you have a bare trust. Check your vehicle logs. Do it now, before the filing deadline.
Here's a final thought to leave you with. We always talk about the Canadian tax system being based on self-assessment. You tell the government what you owe. But in a world where the CRA knows your Uber income, has your crypto trading history from international exchanges, knows exactly when you bought and sold your house, and knows how much your neighbors spend on gas, does self-assessment even exist anymore?
That is the question. Or are we just verifying what the algorithm already thinks it knows?
Something to mull over while you organize those receipts. Thanks for listening to The Deep Dive. Check your Bear Trust status, everyone. We'll see you next time.